Most traders who first look at USD ZAR are drawn in by the movement. Compared with cleaner, slower major pairs, this one feels alive. The candles are larger, the intraday swings are more visible, and the chart often looks as if it is offering opportunity to anyone willing to pay attention. That is exactly why the pair is attractive, and it is also why so many traders misread it. USD/ZAR is not an ordinary forex pair where technical levels alone can carry the entire trading decision. It sits at the intersection of the US dollar, South African interest rates, global risk appetite, commodity sentiment, domestic South African politics, and the constant search for yield in emerging markets. A trader who looks only at support and resistance is seeing one layer of the picture while ignoring the forces that often create the move in the first place. The South African rand can be attractive because South Africa usually offers higher interest rates than the United States and many other developed markets. In calm markets, that yield can support the rand, especially when investors are comfortable owning emerging market assets. During those periods, USD ZAR may drift lower or struggle to sustain rallies because traders are willing to hold rand exposure. That calm can disappear quickly. The US dollar has a different role in the market. It is not only a currency used for trade and investment, it is also where capital often runs when investors become nervous. A strong US inflation number, a hawkish Federal Reserve message, a geopolitical shock, or a sudden drop in global risk appetite can turn USD ZAR from a slow-moving carry trade into a sharp dollar-buying move. The same pair that looked heavy yesterday can suddenly break higher today with very little patience for traders who are standing in the way. This is the central tension that makes USD ZAR interesting for day traders. The rand can reward traders who understand carry and risk appetite, while the dollar can punish anyone who becomes too comfortable with one view. A trader may spend several days making money by selling USD ZAR rallies, only to lose the entire gain in one session because the market shifted from yield-seeking to safety-seeking. That is not bad luck. That is a failure to recognize the regime change. The mistake many traders make is treating USD ZAR as if it should always be traded the same way. They find one setup that worked in a calm week and keep using it when the dollar begins to trend. They fade every rally because the pair looks overbought, or they buy every dip because the previous breakout worked. This is where the pair becomes dangerous. USD ZAR can reward discipline, but it rarely forgives stubbornness. The better approach is to begin each trading day by asking what kind of market is in front of you. A calm market with stable global sentiment is very different from a strong dollar market. A session driven by scheduled data is different again. If risk appetite is healthy, commodities are stable, US yields are not jumping, and emerging market currencies are broadly supported, then shorting failed USD ZAR rallies may make sense. In that environment, the trader is not guessing that the rand must strengthen forever. The trader is simply recognizing that the market is willing to reward rand exposure for the moment. A strong dollar day requires a completely different mindset. If US yields are moving higher, the dollar index is firm, and other emerging market currencies are weakening, then USD ZAR may continue rising even after it already looks stretched. This is where many traders hurt themselves, by calling the move irrational too early. Markets do not reverse just because a chart looks uncomfortable. A pair can stay expensive long enough to ruin anyone who keeps adding to a losing short position. News-driven sessions require even more restraint. Major US data, Federal Reserve decisions, South African inflation numbers, ZAR rate decisions, budget announcements, and political headlines can all move this pair sharply. The temptation is to enter before the release and catch the first candle, but that is often just gambling with better branding. The first move after news is frequently emotional, spread conditions can worsen, and price can reverse before a retail trader has even processed what happened. A more controlled method is to wait for the first reaction to finish, and then study the retest. If price breaks a major level after news, pulls back and holds that level, the second move may offer a cleaner trade than the first spike. That kind of entry does not feel as exciting, but it gives the trader more information. In USD ZAR, having more information is usually worth more than being early. One practical way to trade this pair intraday is to focus on the transition from the Asian session into the South Africa and London trading window. The Asian range often gives a useful reference point because it shows where price settled before deeper liquidity entered the market. Once London and South Africa are active, a break above or below that earlier range can reveal whether larger participants are willing to push price into a new zone. The trade should not be taken simply because price touches the top or bottom of the range. A clean candle close matters because USD ZAR can create false breaks that trap impatient traders. If price closes above the range and holds above intraday value, a long trade may be reasonable. If price closes below the range and sellers continue to defend the broken level, a short trade may be reasonable. The difference between a trade and a trap often lies in waiting for confirmation. VWAP can help because it gives a sense of where intraday value sits. Moving averages can help because they show whether momentum is aligning with the attempted breakout. A TR can help because it reminds the trader how much the pair normally moves and prevents the use of stops that are too tight for the environment. None of these tools should be treated as magic. They are useful only when they support the broader market condition. Mean reversion can also work in USD ZAR, but it belongs in quieter conditions. When price pushes above the previous day's high and then fails to hold, the rejection can create a short opportunity. When price breaks below the previous day's low and quickly recovers, the failed breakdown can create a long opportunity. The key is that the market must be showing exhaustion, not expansion. A trader fading extremes on a true trend day is not being contrarian. They are volunteering to be run over. Risk control is where the entire strategy either becomes real or collapses into fantasy. USD ZAR moves enough that random stops are dangerous. A stop should be placed where the trade idea is proven wrong, not where the trader becomes emotionally uncomfortable. If the setup requires a wider stop, the position size should be reduced. Forcing a tight stop onto a volatile pair is one of the fastest ways to create a strategy that looks logical, but loses repeatedly. A trader with a $50,000 account does not need to risk a large amount on each trade to make USD ZAR worthwhile. Risking 0.25% or 0.5% per setup is already enough when the pair is moving properly. The goal is to give the trade enough room to work while making sure one bad decision cannot damage the account. If a trader cannot accept a small controlled loss, they are not ready for a pair that can move violently without asking permission. The daily loss limit matters even more than the individual stop. USD/ZAR can create revenge trading conditions because the candles are large enough to make recovery look possible. After one loss, the trader sees another move and feels the urge to win it back. After the second loss, judgment begins to weaken. By the third trade, the trader is often no longer trading the market but negotiating with their own frustration. A daily limit prevents one bad session from becoming a personal financial incident. The most important skill in this pair is knowing when not to trade. Some days have no clean edge because the spread is unattractive, the news calendar is too heavy, or price is chopping around without direction. Sitting out may feel unproductive, but it is often the most professional decision available. A trader who avoids bad conditions has already improved their long-term results before placing a single trade. Making money from USD ZAR is not about predicting the rand perfectly or worshipping the dollar. It is about recognizing whether the market is rewarding yield, buying safety, or reacting to fresh information. It is about adapting the setup to the environment instead of forcing one method onto every session. It is about understanding that a pair with large movement can create both opportunity and damage. This is why USD ZAR deserves serious attention from day traders, but not casual confidence. It can offer strong intraday moves, meaningful technical levels, and tradable reactions to macro events. It can also reverse sharply, widen spreads, ignore stretched indicators, and punish leverage. The pair is not impossible to trade, but it demands a trader who respects volatility rather than chasing it. Before entering a USD ZAR trade, the question should not be whether the pair looks high or low. The better question is whether the current market condition supports the trade idea. If the setup depends on calm risk appetite, the trader needs evidence that risk appetite is actually calm. If the setup depends on dollar strength, the broader dollar environment should confirm that strength. If the move is news-driven, the trader should wait for the market to reveal whether the first reaction has continuation behind it. USD ZAR can be profitable for traders who are patient enough to wait, flexible enough to change their view, and disciplined enough to keep losses small. It is far less forgiving to traders who enter because they are bored, increase size because they feel certain, or hold a losing position because they believe the pair has gone too far. The chart may look like an opportunity, but the real edge comes from context, timing, and restraint. In the end, USD ZAR is a test of whether a trader understands the difference between movement and opportunity. Movement is easy to find on this pair. Opportunity is narrower. It appears when the market condition, technical setup, timing, and risk all line up. The trader who waits for that alignment has a chance. The trader who treats every large candle as an invitation usually becomes part of someone else's edge.